right. Hey, everyone. Welcome to the Ultra High Net Worth Clients Podcast. I'm your host, Chris Broadhead. Today, we have the pleasure of talking with Lowell Pratt. Lowell, welcome to the show. Can you introduce yourself and tell us a little bit about you?
Yeah, thank you for having me on the show. Lowell Pratt, we're run an RIA based in Reston, Virginia. We've got satellite offices in different areas. Firm's legacy is equity investment management. For most of our 50 years, that's been our primary focus. We have broadened into wealth management and on the path towards kind of not exactly family office, but we just launched a tax business to complement the rest of what we do here. So becoming a little more comprehensive.
Wow. Okay. Almost a one-stop shop, sounds like.
Well, that's the idea.
Yeah.
Basically, if we can identify client pain points and address those, then, we're doing our job.
Mm-hmm. Awesome. Awesome. Well, a lot to dig in there. I normally like to start at the beginning. How did you get into this wild industry, Lowell?
Yeah. So the big why. So I grew up in a financially insecure household, which led me to be very interested in everything to do about money that we didn't have. When I went to college, I couldn't decide between finance and economics. Those were the two, closest majors to what I had interest in. So I double majored in both of those. I got very lucky out of school that I found the Burney company. They actually needed me for my computer skills, not my investment skills in the beginning, but it was still a foot in the door. And they have an active equity philosophy that has basically been the puzzle that I've been helping to solve for 37 years now. I know I'll never finish the puzzle, but we're periodically through time, we find important new pieces that improve the process. So it's been a lot of fun to spend a whole career right here.
Mm-hmm. Oh, wow. So you've been with the same firm your whole career?
My whole investment career took me about 2 years. Took me about 2 years to get a foot in the door. But once this was just it's a very good fit for me philosophically and professionally. There were opportunities. I got very lucky. They came along at the right times in my development. So I haven't had to ever leave.
Mm-hmm. Wow. That is very unique, especially in this day and age.
Yeah, except if you're at my firm. I'm still nowhere near the most senior person here.
Oh, wow.
This is a place where a lot of people come and just they stick forever. That's kind of every time we bring somebody new on, that's kind of my ambition is to see that person doing something useful here 37 years later.
Mm-hmm. Wow. So what's the secret of the firm to keep people for their entire careers?
Probably more than anything else, it's a culture that we have here. So the founders of my firm, Jack Burney and the original crew, these were mostly West Point classmates, class of 46. They all had 20, 30-year military careers. And there's a culture that's common in that world that they brought here. And, I describe it as balancing sort of running a business with camaraderie and almost sort of like a family feel to things. It's very different than the normal corporate feeling. And there's kind of a two-way commitment that's expected of everybody that's part of this culture. And for a lot of us, that just feels right. And, knowing that we'd have a really hard time finding this someplace else, that's an extra motivation to stay here. But like I said, it's an interesting, the way we go about things as active investors makes life here always interesting from a sort of an intellectual professional standpoint.
Mm-hmm. Wow. That's great. So it's more of a family feel than a corporate feel,
Well,
you
yeah,
believe in the
and I'm going to say balanced. We're running a business.
Yeah.
So
Yeah.
everything's got to be balanced. It's, you need to be a performer as well. That's an expectation that, you go to the military, roots again. performance was an important part of your professional development there. So we have the same philosophy. We have a lot of expectations for our people, but we support them and help them achieve those.
Mhm. Awesome. Yeah, that's an important caveat. It's like family, but you're still running a business. Family is family, but you
Right.
still gotta make ends meet in a business. So you mentioned your active investors. A lot of our guests we have on here, they really just interface with the clients. They don't want to get involved in the investments. Do you take a larger role in the actual investment placements?
Yeah. So I would say that we're sort of the opposite of the normal firm in that respect. Have, we put a lot of importance into building. So first of all, I'll say doing active equity well is hard. That's a very hard problem. To do that successfully, you need to have a lot of resources. So we've built sort of a different sort of team here. Lots of CFAs in addition to CFPs and KIAs, lots of advanced degrees. Um, you know, Understanding that this isn't an easy problem to solve. You got to really resource it to have a chance to be successful with it. And so we have kind of a big group that's focused kind of more on the how to invest in with effectiveness. And then there's also that whole team that is the more classic team where they're the CFPs primarily and they're client facing, and they they have a different and very important role in the process.
Got it. Got it. So any exciting developments in the investment front, or anything on your radar you're excited about?
Well, so from our standpoint, the answer is always yes to that. Uh, but so the two things I'd say that somewhat recent for us that's been very valuable from an asset allocation standpoint. We have a 60-20-20 kind of base allocation, and we're very in fact. I kind of tricked a couple of my guys to go get their KIAs. I told them I would do it with them, and just somehow forgot to sign up for the exam, when they did. But when we decided to get into alternatives, it was very important that we had, the right kind of knowledge base to do that well. And we've been very successful with that sleeve of our allocations. It's really made a huge difference for us. Particularly in comparison to 60-40, that's just been so disastrous for so many investors here that are more convention bound than we are. And then, again, getting back to our roots, we have an active equity process our founder, Jack Burney, I'm going to claim he's the world's first committed quantitative investor. He built models to pick stocks 50 plus years ago. You can kind of see it right behind me, but that's his slide rule that he used at West Point in 1946. That was the computer. I mean, state of the art computing for the early times for him and for the company. And so, the process of sort of refining that capability is never ending. But the big new opportunity, and I described new maybe the last 10 years or so, is we use our modeling techniques to model the types of stocks that do the best after sell-offs. So during market recoveries, there's a very different kind of stock that leads. Just generally describe them as more risk-on type stocks. And so whenever we get big sell-offs, we get to employ what we call our recovery score model. And that's always our most exciting time because the biggest relative return opportunities occur using that model during recovery periods.
Mm. So are you saying we are in a recovery right now?
Not yet. We've been, we've been poised to have one for some time now, but I don't think until you really get inflation, solidly resolved, that there's going to be a lot of potential for a strong recovery. But anytime you have significant market declines, there's always a recovery eventually that follows. So we're kind of, we don't have the crystal ball that tells us exactly where the bottom is. But once you get a big enough drawdown, the opportunities there, you just need to be patient and, to capture it.
Mm. So what Do you think in the next 6, 12 months?
I hope.
Somewhere? Yeah.
Again, we don't have any crystal ball here. We have a lot of confidence. We have a very healthy respect for the stock market, the way it behaves. We have a little bit of an unusual view of market declines. I mean, to us, not only are they inevitable, but again, they're big opportunities as well. So we don't mind those as long as we have the investor patience in order to take advantage of them as they occur. But exactly when those big market hits and then subsequent recoveries are going to occur, we have no more knowledge than anybody else on any of those.
Awesome. So you said the 60/20/20. I'm assuming it's stocks, bonds, and then alternatives is the other
Yes.
20?
Right.
Cool.
So, and the alternatives, I guess we've got our own equity piece. We throw in some international, to broaden that diversity. On the fixed income side, we've been sort of short and intermediate to just short, and then we're just made a decision today actually to start to move back duration into intermediate, but we're kind of staying very conservative with that particular sleeve. That's our stabilizing sleeve there. At least the returns are less awful than they were, a short while ago. And then the alternatives, it's managed futures, it's private credit, and it's private real estate are the three main allocations we have within the alternative sleeve.
Mm-hmm. What's your perspective on the future of just the alternatives as an asset class? Is that it's going to be easier access? Of course,
they're easier access. Yeah, I mean the big negative is well, maybe two big negatives. Fees are one big negative, much more expensive products, and then liquidity can be an issue also with some of them, not all of them, but some of them you have liquidity constraints. But yeah, I would say going forward, now that they're here and they've been democratized and we've got access, regular investors have access now to some of the types of investments that only institutional investors typically had access to. Yeah, I think they're an enduring part of the investment landscape as far as I can see into the future anyway.
Mm-hmm. Yeah, it seems every financial advisory conference I go to, it's all about alternatives. People are sick of stocks and bonds.
Yeah, and it's an important area to really pay attention to, because the big lesson for all the people that went through the Kaya program is that most of alternatives are overpriced junk. They're it's a minefield of very disappointing, with the benefit of hindsight, investments that are out there. So being capable of being very selective is essential for doing that part of the allocation successfully.
Mm-hmm. How do you grade alternatives when considering them?
I mean, what our due diligence?
Yeah.
So the main thing that we're looking for are asset classes that do not correlate strongly with stocks and bonds, right? This is the whole idea, is these are supposed to be diversifying assets. Kind of the second piece of this is we don't want to make enormous return sacrifices. I'll compare everything to stocks. You've got a nice, straightforward opportunity to get something like a 10% annualized return over long periods of time. So let's not mess that up too much by throwing in other things. But there's a number of private, alternative type investments that don't come with enormous performance sacrifices. And then the privates of any flavor, they have actually, I'll call it a cheat. It's like a legal cheat that they get to do. If you compare, stocks and bonds and real estate that are all traded on the public markets, you get these panic events that temporarily depress prices, and then they quickly recover, and you get all this volatility that's really, in the end, just emotion kind of flowing through the markets. On the privates, they always get to market their underlying investment. So you can have a panic, but if the office building is still worth what the office building was worth a month before, then you don't get that big price volatility. So they sort of artificially have smoother pricing, which gives them a big diversifying place in a portfolio. And then, so that would be the two privates that we use, the credit and the real estate. And the managed futures, they're designed to be different than everything else. And they always have something close to a zero correlation with stocks and bonds. And you have to be very patient, because a couple of years ago, that was our least favorite allocation for all of our clients. They all told us how much they hated our managed futures. And then, of course, they had a spectacular year right after everybody, many others gave up on them. So you have to have a lot of stick-to-itiveness and really view this from the long view of what it's doing for the mix of assets that you're managing.
Mm. Well, I think a year like 2022 will motivate a lot of folks to look outside of stocks and bonds. They're like, how are they both down?
Yeah, exactly. It's and especially some of the magnitudes. It's just not something, the long bonds, they've had the worst year ever was last year. This year looks like it's going to be even worse than that. It's just really terrible.
Yeah. We're in some wild times.
Yeah.
So that's awesome. I'd love to take a step back and hear about how you started your practice, how you found clients, if you focused on a certain type of client, and if you could just take us down there. Yeah.
So again, the firm's a little bit different. We have an active equity strategy that's had success for a long period of time. We have, for most of our company history, we've had really the privilege of having other financial professionals, investment professionals, refer clients to us. So our best opportunities would have been probably in the 80s, when the wirehouses were referring clients out to advisors, and there was, they didn't call it separate account management back then, but that's, what it was. And then more recently, the discount brokers, the TDs, the Schwabs, they had referral programs where they did the same thing. So we've gotten most of our business through the years from really referrals from other investment professionals. And then once you have those relationships, then you have the opportunity to manage those. And if you're doing your job well, there should be a secondary flow. It's from your clients. So we get our best new clients from our existing best clients, for sure.
Awesome. So I'm sure exceptional performance delivers a lot of referrals. Are there any specific strategies you employ to encourage your favorite clients or largest clients to deliver more referrals?
Yeah. So we did some Bill Cates training, and the gist of his approach is just ask, and I would say actually great performance is not the attraction that the power of that as an attraction is actually not as strong as one would think. Because anytime you have an active strategy, you're going to have volatility in return, and inevitably you're going to have some off periods, and there's a lot of damage that's done whenever that happens. So I would say building a reputation and a brand is as important as the performance that underlies that. But yeah, basically for the clients that you have, it's just forming deep relationships, and then recognizing that they're going to have friends and family that are not as well served as they are. And all you have to do is start that conversation, and it should lead naturally to introductions.
Mm-hmm. Awesome. So do you and Burney do any other types of marketing to find clients?
Yeah, we probably spend way more on digital marketing than we should. We've got lots of younger people around here that are very enthusiastic about the potential for that, and it's slow going. We've had some success, and I don't know exactly how to balance all of this, but CNBC comes out with an advisor rating, as many others do. And for the last 2 years in a row, they've ranked us number 1 in Virginia, number 9 nationally, among RIAs. So taking that digitally to the world and beating the bush for clients, that actually gets some traction. It's really when you don't have that, it's a lot more difficult.
Mhm. Okay. And have you noticed any aspect of the digital marketing kind of stand out above the others?
Uh, Advertising's not been successful for us, and I know that there's others that use that more selectively and
Mm.
or effectively than we have. Um, it's I don't think I can say. Basically, we have kind of we cast a broad net, and we occasionally catch little, sometimes not little fish, but it's a long, slow process, and I'm not sure that really, candidly, the payoff is there. Like it's a lot of time and money invested to get some clients. You get some, and for the younger people, it's fun and exciting to go that route too. But I think the old fashioned, spend more of your time and money with your clients has probably got the better payoff.
Got it. Got it. So do you put interfacing with your current clients, is there some sort of schedule to that? You're like, I want to make sure this relationship is very strong. Is there some sort of cadence there? Any advice or thoughts you could
Yeah.
shed
Yeah. And again, I'll go back, legacy of the firm is investment management. We have a lot of clients that still just use us for equity investment management. You're not able to form relationships that are as deep if that's basically all that you're doing for them. On the planning side, on the wealth management side, you can delve into their whole financial life. As I mentioned, we've got a tax practice that we've opened, so now we can give tax advice as well as investment advice. The more broad your relationship is, the more the opportunity is. And so for those types of relationships, it's probably at least a quarterly check-in, probably trying to meet at least once, in person per year, depending on location. We've actually got clients all across the country. So it's not always possible to meet each one in person, but I think, for us, especially really being able to get a thorough understanding of what their financial, objectives are and what their constraints are, and, kind of their philosophies around a lot of their financial decision-making. The more we can do that well, the deeper the relationships become. So, the problem with that is it's very manpower intensive. Like you need an army of people involved in that relationship management to really do that well, but there's good payoffs for that. That I feel very confident has a solid return on investment.
Yeah, I agree. I enjoy speaking to my clients. I enjoy this podcast. That my wife is like, "Oh my gosh, you have to talk to 4 people today." I'm like, "Wait, that's like the best part of my day."
That's right. That's right. Well, I mean, if you enjoy the business, then yeah, talking shop's always going to be fun.
Yeah, yeah. No, it's fun. It brings me to life. It's much better than answering emails or
I
you
hear
know
you. Yeah.
double checking things. That's awesome. So, uh,
Let me offer one thing that we haven't
yeah,
covered yet
please.
that I think is also kind of important to understand about us. So the Burney Company has advisors as clients as well as investors as clients. So we've got, in fact, the core Burney Company doesn't have any end investor clients. And briefly again, the firm was founded by career military officers in their first careers. All of them had the same experience where you had these rotating jobs where you're in the field, you're in command of troops, and somebody tells you to take a hill and you get to go take the hill. Everybody loves that job. And that for us is what the advisors do. with their clients and with their books. And then they rotate off that and they become, basically a support officer. And then they just go back and forth between the two. So, I wore my shirt for you today. The symbol is the Pentagon. And that's the ultimate, kind of symbol of that military support structure, that they don't get to have the fun that the advisors in the field do, or the troops in the field do, but they perform a very important function. So the Burney Company has actually always been set up with that structure. The core company, 50 years now, we're in our 50th year, is a support organization that supports advisors, and it helps them be, basically takes, active equity, 60-20, the tech stack, the compliance, the marketing. It's all the non-value added part of running a business, off of their plate, and they can really just execute the strategy and deal with their clients. So it's a very efficient type, but different structure. There's not a lot of firms that, that are like us in that regard.
Mm-hmm. Yeah, that was going to be my next question. Is this a common? It's not a common structure for a business.
Yeah. If you didn't have a 30-year retired, Army general setting up the company 50 years ago, you probably wouldn't wind up here. But it's perfectly sensible if you understand what their perspective was coming into the formation of the company.
Mm-hmm. Wow, that's very, very unique. You're obviously the first guest that I've had on who has that business structure.
Well, and what's fun is, like, I've got a couple of friends, as an example, that have plugged in for our support. They run, I'll call them competitive firms. I don't consider them competitive firms, but they have their own book, they run their own business, but they also philosophically align with the opportunities around active investing, and again, the 60-20-20. So to be able to network and support those, as well as we've got a group of internal advisors, it's great. And that's kind of a second dimension that provides a different channel of growth for the company.
Mm-hmm. And does that mean you all directly manage their assets, or you are an advisor to them?
So it depends. So if you're an advisor, like the relationships that we have right now, all of them actually execute their own strategies with our support. That's what we typically have done. But if somebody doesn't want to do that, and they just say, hey, we'll identify the risk bucket that this client belongs in, go execute for us, we could certainly do that as well. And so we're prepared to do the more traditional sort of TAMP solution to the investment piece of it. But we're really mostly geared towards helping arm people to be successful doing what they want to do with their investments.
Awesome. Cool. So it sounds like, you guys definitely have a unique business model. Is the best way that you find clients to support and clients to serve, it's just referrals, relationships? What has been like the best way to find good partners here?
Yeah. So we've got a lot of successful experience with referrals from other professional investment professionals. That's certainly been a big part of what we have been traditionally. We're not involved with any referral arrangements right now. So, the current focus is just on the client referral. And then hopefully we're going to crack the nut of digital marketing, and that'll turn into some bonanza one day.
Yeah. Awesome. So this program is titled the Ultra High Net Worth Clients Podcast. So I do love to delve into that to the extent that you were comfortable. How did you find your largest client?
So interestingly, our largest client today is a client that was a broker, wirehouse broker, more than 35 years ago, that referred clients to us and then gave us some of his own investments to manage. And, this guy's great. He's like the nicest guy you'll ever meet. Sadly, he's going to retire by the end of this year. So, a long relationship is, well, sort of coming to an end. He's still our client though. So we'll have it a little bit longer. But for him, he really didn't start as an ultra high net worth. I mean, he, had a significant initial investment, but mostly it's just all in the market for more than 35 years, with a successful equity approach. And that translates into our biggest client today.
Mhm. Compounding interest and practicing what he preaches. Sounds
That's
like.
right. Well, and
Yeah.
he's great. Market, think about how many big market declines have occurred in the last 35 years.
Yeah.
And,
A lot.
and he doesn't bat an eye. He just he looks at those same way we do. That's opportunity. If he's got any cash on the side, it's time to push some of that in. He's got all the best instincts for being successful with equity investing.
Mhm. Wow. That's awesome. Well, great. Well, it looks like we're going a little over time here. I want to respect your time. I could definitely ask you active investing questions for the rest of the afternoon, but I will fight that urge. My final question, and it's an open-ended one, so you can take it any direction you would like. It is, what are you working towards?
So I've got one last chapter for me. Jack almost made 50 years with us. I'm not going to go 50 years, but I'm going to certainly, health allowing, maybe make 45 would be a nice, almost as good as Jack number to get. So, I've been able to build this company to pretty good scale, which means that I've got depth with the personnel, and I've got strong leadership in parts of the company, and other parts I'm still kind of working on that. So getting, I guess my last hurrah is going to be continue building the company as we've done, but start to identify and find replacements for running this company when I'm not around to run the company. So, that I think is my last mission here.
Mhm. Any promising candidates from the millennial, Gen Z,
Oh yeah.
Gen X?
All of these, all my buddies that don't have many of these people in their shop, they all have a bad attitude about them. These are really smart, obviously very tech savvy, motivated people. I love, it's crazy how really young our companies become in that regard. So there's almost too many candidates. They need some seasoning as well. But there's lots and lots of people that are going to have the opportunity to bubble up, and they already are. I mean, we if you have success with growth, you're going to sort of be in a position where you're going to need to push people to do things maybe a little sooner than they would feel like they're ready to do it. But with the right support, most of them will succeed if you give them that little nudge into the deep end. So no, I'm very excited about the young people that we have been able to bring into our ranks.
Mhm. Well, I'll say this, Lowell, you're open-minded enough to be on a podcast, with a millennial, that says a lot. So I think you're on the right track, and you'll find someone great there to keep the torch lit.
That's right. I'm
Yeah.
confident that I will, and I appreciate this opportunity.
Yeah, well, I appreciate you taking the time, man. You're a wealth of knowledge, and a pleasure to talk with, Lowell. So,
Likewise.
yeah, awesome. So where can our audience find out more about you and Burney?
So we're actually, I don't hesitate to share this, but we're involved with the SEC inspection right now. Just the routine, whatever. And one of their gigs on us is that we're not clean enough in terms of describing all the different things that we do. So it's not quite up yet, but if you get the way it's going to look shortly, it's Burney.com. We'll have underneath of it investment management, wealth management, advisor services. So all the different elements of who we are will all map underneath Burney Company, or just Burney.com. In the meantime, it's Burney Investment Management for the equity piece, Burney Wealth Management for that. For advisors, it's Burney Advisor Services. Would be the three different websites right now that we maintain.
That's also very impressive to a millennial that you have Burney.com.
Well, it's funny. Good friend of mine, IT guy. Actually, he and I did this big project here years ago where we sort of pioneered what would be called AI now. It was neural networks then, but like AI as an investment approach. And he was plugged in enough to know the importance of getting that. So he got that for us, and then gave it to me when he left. So I cannot. I wish I could claim more credit for that. I just lucked into Burney.com.
Hey, you hire smart people. That's the smartest thing you can do.
Well, he is very, very smart guy.
What, that must have been like mid 90s.
That would have been in the 90s. Yeah, this would have been like probably late 90s. And it was fascinating. It's like it's surprising to me that it took 20 years really for it to hit. But that whole power of machine learning has been there for a long time. And I know a lot of the firms that are rolling out their AIs right now, they've been working on this for a long time. And maybe made a big mistake to stop working on it 20 years ago. But it was a fascinating project that we just, well, I won't get into it, but there's reasons why we did not succeed with that as an investment tool that relate to really the tool. That approach is so powerful. It can find connections that well, they don't generalize. They're like, I wish I had still had some of that project running because it was a lot of fun. We learned a lot.
Yeah, yeah. Are you seeing anything on the AI front that you're excited about right now?
Oh, absolutely. I think that the forecasters that are observing that this will be as transformative as the internet was, I think they're spot on. Yeah, everything will be different. Like I can't tell you, my crystal ball doesn't show me how it's going to be different, but it'll be significantly different and better in the end. But this is a disruptive technology, so there's going to be winners and losers. I think a lot of the big winners will be the firms and the individuals that learn how to employ this the best. They don't need to be the originator of the tool, but they just need to learn how to use that to effect. And the firms that are not gearing up around this are in big trouble. They're going to wake up dead, in no time.
Yeah. Are there any AI tools you guys are enjoying or benefiting from currently?
Yeah. So we've got probably the last 5 years. So I didn't completely abandon the AI. So about 5 years ago, I found a firm that does predictions. It's the model that we use. It's their revenue surprise model, but it correlates with earnings as well. And so with a high degree of accuracy, they can forecast like with 90% accuracy, the companies are going to have the positive surprises and then those 90% accuracy of the disappointing ones. So as a tool this is a tool that we use to help with the timing of when we buy and sell things. It's extremely powerful. And this is a machine learning, unconventional data. Basically, they scrub a bunch of socials and then they compare, I'll call it the buzz that they're getting from those sources against what analysts' expectations are. And where there's the biggest disconnect is where there's the biggest opportunity. So that's been a very powerful sort of newer part of our investment process that's been great for a long time. And then the whole chat GPT and all that, there's I'm embarrassed to say there's probably very little original content around here that doesn't have some of that generated that way. It's really good stuff. So, and really we're scratching the surface of what this is going to be like in a couple of years.
Yeah, it's hard not to push that button, especially in emails now. I write a very formal email and I'm like, that seems very professional and I'm proud of that. And there's just a button in Gmail now. You go formalize this. And it makes it like, wow, that's way better.
Yeah, bravo. And until it becomes our doom, this is all going to be great.
Yeah. It's it's gonna be amazing until it hopefully it doesn't go that way. But yeah, we'll we'll keep an eye on it until then. Well, awesome. Well, Lowell, thank you so much for taking the time to talk to me and my audience. Super enjoyed getting to know you. And to all our audience out there, thanks so much for tuning in. Keep on growing out there, everybody, and we'll see you next time.
All right. Thank you so much.